Welcome to the CXR channel, our premier podcast for talent acquisition and talent management. Listen in as the CXR community discusses a wide range of topics focused on attracting, engaging, and retaining the best talent. We're glad you're here.
Here's what the hour is going to be like. If you have not been reading anything about the SEC guidelines and the new requirement for human capital metrics, I think after this conversation, you will be very interested in it. I do want to provide a little bit of background, but I'm going to, in a couple minutes, introduce Dr. Solange Charas, who will help us take a look at one or two of these key metrics that are out there, some of the work that she's been doing for some time, that I think are going to be foundational for many companies going forward. And so I think it'll be an interesting ride for sure. A couple things. For those few of you who have not been involved with Career Crossroads in the past, we are a community of talent peers. So this is a group of peers and colleagues who kind of help one another. We've got about 150 corporations and brands heavily involved in our community. And we have a small but powerful little group of folks, obviously including Chris and Barb, and you can wave as I say your name, and Shannon, and a whole host of folks who are helping us in a variety of different ways to get things done and to curate content and make sure that you have what you need. Clearly, our community resources are a fairly large range of things that engage folks from a community point of view and being able to talk to each other online, as well as it used to be face-to-face, and hopefully soon we'll be back to some face-to-face, which would be kind of key. But we've been experimenting this whole year with different ways to approach meetings and to keep our members and our friends apprised of some of the key issues that we think are happening. And I'm convinced that the announcement that the SEC made in August 26 is in fact probably one of the most powerful things that has happened in the last 20 years, in my opinion, and is probably over the next 2 to 3 years will work itself out in kind of interesting ways, but I don't think anybody is going to be able to avoid it. And this is just some of the exchanges that our members are currently engaged in talking to one another and benchmarking some of the things that they do. So today's agenda really is to focus on a couple things. One, I do want to take a couple minutes to tee up what I think we're going to be able to learn and understand in the conversation that we have with Dr. Charas. So I want to give you a little bit of a backstory on why the SEC announcement is transformative for those of you who have not delved into it yet, and then spend some time with Dr. Charas to really focus in on some of the work that she's done and the calculations that she's looking at from a human capital ROI point of view. I think they're important. I think they're part of the kind of metric that most corporations will probably incorporate. But obviously there's a lot of conversation going to be going on around that. And then anywhere along, but certainly I want to provide a little bit of time for any kind of open mic so that there's conversation here that we can use to help inform our members. So Dr. Charas, would you just say hi?
Hi.
There, good. I know your voice works, so that's a good thing. So it's great. And Dr. Charas has been active for quite a while in a variety of different roles. But I think what brought her to my attention was a roundtable that I listened to her talk about some of these issues, particularly the human capital ROI. And I was just entranced by the fact that she has a company that she dared to call Human Capital Moneyball. I just thought that was a fascinating attraction just for me from that point of view. But she teaches as a professor at Columbia University and New York University and USC. She's a distinguished fellow at the conference board, so she's very active. in some of the kinds of communities and organizations that fundamentally are doing some critical research for corporations, as well as her involvement in her colleges, Case Western, Cornell, and UCLA and Berkeley. And so that's for me. She's got a very long resume. I just stuck a couple key things in there that I think help people get it. So what I want to do is to give you a fast, brief overview that sets up, I think, the conversation with Dr. Charas. So I don't want to spend too much time on it. But I think the critical things for me, this is my take, is that August 26th, there was a kind of a quiet ruling by the Securities and Exchange Commission that said they wanted to modernize the regulations and disclosures for quarterly financial filings and annual reports, that added human capital resources as a separate disclosure item. And that was pretty much it in some respects. What I was fascinated by, I don't know if anybody knows the answer to this, but previous to this, what was the one human capital measure required prior to this announcement? I know you know that.
No. Number of employees.
Number of employees. That's it. That's all you had to say. But in every single annual report, what do you usually start out with? That human capital is our biggest asset, right? So some companies are probably lying about that, but no one's holding them accountable in relation to that. And that's kind of the key. The SEC is an extremely powerful organization founded in 1934 in part to reduce investment fraud. And for years they built, I mean, there's other things obviously, but I'm just giving some highlights that hit me. And one of them is that the financial measures have been established for many, many years. And they were established at a time when you focused often on the tangible assets to determine the value of a corporation that you would invest in. But that has changed over the course of the last number of decades. So most companies now view some of those intangible assets, particularly human capital, as the critical asset that we have, yet we are not putting metrics together for that you're held accountable for. And so that's what the biggest issue and change is. And so from my point of view, there is a quick backstory that I've confirmed from several sources, that a group of 26 institutional investors like Fidelity, who have $3 trillion in assets to invest in stocks, last year petitioned the US Securities and Exchange to do this because they want to change the way that they invest in stocks in the future. So imagine for the moment that you are a CEO of a corporation. There may be a lot of things that you want to do that are good for the world and good for your company. But one thing you do want to do, and that is something that's good for you, you want to make sure your salary continues and you want to have a good bonus. And
Jerry, we think this was the catalyst.
I think this is the catalyst. Okay. I think if I'm a CEO of a corporation and I know that my stock might get changed, not based on what I've been doing, but what I either fail or do in the next few quarters, I'm convinced I'd be all over this with the CFO, and then quickly with the CHRO, and then kind of the shit keeps on going downstream from there. So, I just think this is coming. I think it's still at an early stage. I do think it's going to be a couple of years before it all settles out for a variety of reasons. But I think this is the most fascinating thing I've seen in a long time. And there are a couple key things that were in what the SEC did say. They said, and when I was talking to Dr. Charas, this came up a couple times too, is at some point, the company has to determine what is really material to how they manage human capital, how they manage their workforce. And that's what they have to be able to declare and make some metric on. They have to be able to disclose around that. that they gave non-exclusive examples for the human capital measures, but they didn't require a specific one in their announcement. And so that's where some of the pushback is. Oh, I'm going to wait until somebody gives me a requirement. You know, it might be too late. I'd much rather be upfront around this. I would rather be advising my managers and my bosses that we should be determining what's best for our organization. And one other piece to this, because there's two more slides that I want to make sure I mention. But those non-exclusive examples all came word for word from a publication that was published from a paper that was written and published in 2018, which I'll get to in a second. And the last piece was that as part of this example, they said such measures as that address attraction, development, and retention. So that puts TA, it puts learning, and it puts anybody who's in charge of retention in the sights.
It's everything.
Clearly, it's everything. So this is the last piece of this. And I want to encourage all of you, if you haven't downloaded it, to go do it. The publication from 2018 is ISO 30414. So if you go to iso.org, you look for 30414, and you have a credit card that will take on $138, you can have this. And I don't get any piece of that, by the way, but I'm sure that the ISO is making a lot of money with all the people downloading this to try to figure this out.
You would think.
You would think. I mean, it's certainly going to happen shortly. Now, here's the point about this. In this document, there are standard definitions there. Obviously, this is a kind of a foundational point of having a conversation rather than, a fait accompli. These are de facto choices made by 40 countries approximately in agreement, and they came up with 58 human capital metrics, one of which is human capital ROI. And I don't even know if their definition is similar to yours, Dr. Charas, but I have a feeling it's close.
It's exactly the same, because what we're trying to do is create global consistency so that when you read in a financial statement, this is our HCROY, you know that there is a standard way that has been calculated, like
Good.
An ROE or an ROS or an inventory turn or any financial calculation. What ISO is trying to do, and what the practitioners around the world are trying to do, is create a standard way of calculating these numbers so that they're reliable, they're valid, they're consistent, and you can benchmark against them.
Right. Good. And so
is this chart
a good segue for getting in. Go ahead.
I'm sorry. For some reason, my video won't turn on. Jerry, is this chart right here a part of that download?
No, actually, this is pulled from that document, and it comes from a slide produced by one of the folks who actually participated in it, a guy named Zahid Mubarak, who heads up the ISO committee in Pakistan. And I think there's a certain irony that there's a whole group of people in Pakistan that know more about this stuff and are working to develop and improve on those standards as we speak. So that's just, to me, it's fascinating. But you will get a copy of this deck.
Okay,
right?
great. Thank you. Perfect.
So that's not a problem. What you'll see in the document is essentially a long list of definitions. And what he did is he pulled from those definitions and pulled them into the various components that they had conversations on. But keep in mind, this took 2 to 3 years to get to this level.
So can I just clarify this document here? This is part of the SEC requirements?
No. So let me be real clear. The SEC never mentioned to my knowledge, the ISO document.
They didn't.
What the SEC did was say, you need to produce in your filings and your annual report what matters, okay, in how you manage folk. And here are some examples. And when they described the examples, they used this document. I would claim that they used this document because I went matched word for word some of the stuff. But so, you won't find a better, I think, starting point. Dr. Charas.
Yeah, so let me, is it my turn to talk or are you done, Gary?
Yeah, pretty much. I'm pretty much done unless there's any particular questions, but.
I have a question.
Yep.
Can I ask a question? Thanks. So are we suggesting that what is in this ISO 3414, which the SEC document references as an example, that if I was a publicly traded company, my TATM will be part of the evaluation of what investors would want to invest in? Or are we suggesting that ultimately we're going to come up with how we're going to have real formulas for how to calculate 27 through 38 that are going to become uniform? I just want to make sure I'm connecting the right dots here.
I'll give you my opinion, then we'll start moving into what Dr. Charas can offer. My opinion is this. The answer is right now, and we're talking about it early stage, the SEC is saying every company has to determine for itself what matters. And if they want to claim that humans have nothing to do with the performance of our organization, they can do so. And then they don't have to show anything. But I don't know too many companies that do that. And if they do say that there are some things that matter, then they're going to have to identify what they are, and they're going to have to show how they measure that. And they're going to report that to all those investors out there who will begin to consume this and start making choices about that. And then what will happen is an iterative process, in my opinion, over the next couple of years, in which some measures will be better than others. Some measures may need adjustments. Some measures may be more important for some industries than others. And so those things will evolve. And at the same time, some countries who might jump on this, including the US, might start saying, you know what, we're smarter than the companies and we're going to require by fiat that you do some of these measures anyway. And if you look at what some of the states are doing, they're already building into the law requirements around some of these issues. So with that in mind, I'm convinced, and that's one of the reasons why I asked Dr. Charas to join us, and I appreciate the fact that she did, is that's the last slide, is I'd like to focus a little bit on some of her work in relation to all of this, because she's been doing it for a while, and particularly the human capital ROI metric. Okay. Yeah. And I do think we need to potentially give you capability to share your slides. Is that true?
Yeah, I just have one slide that I want to share. So if you just mind letting me do that.
So can you help with that, Barb, or do I have to do anything?
Jerry, if you stop sharing, then I've got Solange set up. She can start sharing now.
Okay, I did.
So thank you for asking me to speak to your group. I'm very excited to do so. Just a little background on me. I know that Jerry said a few words about what I'm currently doing. And, you know, when somebody says she's got a really long resume or she's, you know, done a lot of things, that equals old. So I am old. I consider myself to be a junior senior. I'm in the senior category doorstep. I'm not over the threshold yet, but I've done a lot of jobs. And I know it's not nice for a woman to say, but I've been around. So seen a lot of things from a lot of different perspectives, being a client server in 2 Big 4 accounting firms, being the head of HR for 3 large organizations. So I've seen both sides now. I've served on public company boards as a board director, chairing the NomGov committee. I've served boards as a client server. I've been on nonprofit boards. I've been on for-profit boards. I've been on public company boards. I've been on private company boards. So I've seen this. I've seen the role of HR, the impact of HR from every different angle, including being an employee, right? So we can't dehumanize it. I've also been an employee. So I've been around, I've seen this. I have been in the human capital analytics space, believe it or not. You guys think it's a new thing, right? Oh, human capital analytics, that's a few years old. I've been doing this since 1996. So like a long time. So we finally are basking in a few rays of the sunshine that's going to shine on human capital and human capital analysts because of what's going on in the world right now, both from a social perspective, from the human perspective, as well as the corporate perspective. You know, another thing that people are probably thinking is, oh, this whole thing about human capital disclosure, that's new. It's not new. It's been going on for a long, long time. We finally got some attention on this because of the SEC. So what I do want to do is I want to share with you something that's going to be in an upcoming report published by the Conference Board, which is a report that I've researched that I've been working on for the last year and a half. We brought together a working group of corporate directors, human capital experts, legal experts from public and private sector. We brought in investors from like investor communities, so institutional investors and individual investors. And we had a series of 5 meetings with this working group. We had more than 250 professionals participating in these working group sessions to really understand the question of, does human capital management matter for corporate governance? So we're looking at the intersection between ESG, environmental social governance, which is sort of the evolution of CSR, corporate social responsibility, and human capital management. So if you think about ESG, environmental social governance, the environmental is easy, you know, looking at carbon emissions, looking at carbon credits, looking at the green aspect of how corporations perform in terms of their responsibility, their governance responsibility. The S part is social. So how do we deal with our communities and what impact do we have on the social landscape? But that also includes, how do we deal with our employees? How do we manage employees? So what we did is we basically looked at a bunch of governance monitoring agencies, because these are the people that were interested in ESG. And you can see across the top, we've got a whole bunch of governance monitoring agencies that we looked at. The HCMC is the group that Jerry was talking about that has $3.6 trillion under management. These are the big institutional investors. They are a consortium. The HCMC is called the Human Capital Management Coalition. It's a consortium of large institutional investors, mostly pension investors. The UAW, led by Meredith Miller, is the head of the HCMC, but CalPERS is their CalPERS and CalSTRS is their large institutional investors. And they all got together and they've been working for the last, I'd say, at least 7 years to understand from an investor perspective, which organizations are treating employees well and which employers are not. And is there a relationship between the way employers are treating their employees and a return on investment? And the HCMC came up with the answer that yes, it does make a difference. And how do they know that? They started talking to big employers, Coca-Cola, GM, Walmart. They went and started talking to big companies to understand their programs around human capital And they determined that there is a relationship between how employees are treated and whether or not investors are getting a return. That's when they put together the letter to the SEC. And the letter is 20 some odd pages, which I'm happy to share with you, that has about 100 and some odd academic references. So this isn't just, oh, it's our belief. It's actually bringing together practitioner and academic observations. They petitioned the SEC back in 2017. And they said, as investors, we believe that we cannot do a good job investing for our members, our pensioners, unless we understand how companies treat their employees, and they treat their employees through their human capital programs. So we actually have to understand whether or not companies are optimizing their investments in human capital by servicing their employees, because that in turn turns around and creates economic value for the investor. The HCMC, which is the first column here, is included because they were very prescriptive in their letter to the SEC saying, we want to see these metrics. We want to see occupational health and safety performance. We want to see diversity. We want to see training. We want to see, you can see the list, employee engagement, employee benefits. Now, the HCMC didn't ask to see employee recruitment, but you can see that others do. They want to see employee turnover, human rights, cost. They didn't ask for information about labor and management relations, but they asked for productivity. So you can see what the HCMC looked at. IIRC, ISO, GRI, the World Economic Forum in conjunction with the Big Four accounting firms, ISS, Institutional Shareholder Service, SASB, and the UN SDG have all asked for information to be reported so that they have a sense of governance around the S part of ESG. The S is mostly human capital. So I don't want you guys to think that the SEC woke up one morning and said, oh, maybe we should ask companies to report on how they perform on their investments in human capital and whether or not that's material, which we all know it is, wink, wink, nod, nod. They didn't just wake up one morning. There is a wave, a tsunami of pressure that was building up to the SEC finally taking a position. So I'm happy to share this slide with you. There is like a 25-page report that's going to be published from the conference board at the end of this year. I don't think it's going to, I think they're really going to try to push it out before the end of the year. If not, it'll be like the first week of January. You'll be able to read the report. Let's see, stop sharing. You'll be able to read the report and see how the conference board with that working group actually tackled this concept of human capital management. Is it material? Does it matter? Who should be looking at it? Who in HR? Who in finance? Who on the board? What are the resources available? It's a great report. So, you know, you can reach out to me. I'll make sure that you get a copy of it. It's public, so you'll be able to access it without paying for it.
And most of the folks on this call, by the way, their companies belong to the conference board.
Perfect. So you're going to get it anyway.
Well, they may not get it, but they should know that their boss's boss is probably getting it.
So
I ask a question about timing on this.
Yeah.
What's the timing of something supposed to be done?
Yay.
November 9th.
Because if this is like OFCCP, I'll probably be dead before this happens.
So you should know that the SEC modernized their reporting requirements in August, and the deadline for reporting started November 9th. So on November 9th, companies that are submitting are filing either their 10Ks, their 10Qs, their proxies, or any information related to Rule 101, anything in Rule 101. That human capital reporting is in Rule 101C, Section 101C. So if that
was only that one human capital metric, though.
No. That one human capital metric has been required since 1934.
Right.
Oh, okay.
And that was it. This is why it's such a sea change, Brad.
So
I'm just trying to figure out what are the metrics that they're going to want, because I'm sure it's going to hit my desk at some point.
Don't worry about that for the moment, because the way that the SEC has framed this requirement is if it is material. So organizations have to determine on their own whether or not it is human capital is material, what aspect of human capital is material, and that's what you need to disclose. Now, what most companies are disclosing right now is around diversity. They're not getting sophisticated. They're not even saying whether or not diversity is driving performance. They're just now being disclosure forward and saying this is what our diversity looks like. Most organizations don't have a policy around human capital materiality. So you want to be thoughtful about this, right? You don't just want to go out in the world and say, oh, this is our HCROI. I mean, I love the slide that summarizes the ISO 3414. It's a beautiful slide. It gives you a lot of ideas, but that doesn't mean that you're going to report on 54 items. And by the way, to create those 54 items, you have to collect 145 data points in your organization. So
this is a starting point, Brad, but the fact of the matter is there has been a significant increase in the number of suits by investors.
Thank you.
And as a result, if you don't disclose what is material, and someone out there thinks that hiding that is a problem, that you're now going to see suits that are going to get supported by what the SEC can control. And now you're going to have a harder time, or you're going to be hiring a lot more lawyers. But I'm convinced that we're going to see a lot of things driven in the next couple of years.
So
I think the kick for this to me is the organization selecting what they think is relevant,
right.
To report out on, and whether or not what they have selected warrants or justifies a lawsuit or does not justify that lawsuit.
Exactly. So here's the key to the SEC disclosure requirement. The key to the SEC disclosure requirement is that it is principles based, right? Which means that every organization is going to view what is material to their organization differently. The SEC absolutely did not want to come out with a cookie cutter approach. They did not want it to be like Sarbanes-Oxley or Dodd-Frank, where it's a check the box, because that misses the point. The point is, this is principles driven, policy driven, not reporting driven. So what I would say is work with your accounting firm, because SASB has this list of what they want to see, but it's FASB that's going to drive what gets reported, because FASB, the Financial Accounting Standards Board, is going to be the one that's going to be the arbiter of whether or not something is material or not. And your accountant, your accounting firm, and your CPA will be closer to that than you will, right? So my first recommendation to you is get close to your CFO, get close to your external, your auditor, your outside accountant. Ernst & Young, my alma mater, and parenthetically, the best place I ever worked, yay, Ernst & Young, came out with a document called How to Approach the SEC's New Human Capital Disclosures.
Wow.
They did a paper. You can type in Google How to Approach the SEC's New Human Capital Disclosures and Ernst & Young, and it will give you a hot link, which will give you this report. I don't have the front page. The front page is just a picture. This is the first page of the document. Neri Buxbaum was instrumental in this document, and Neri and I did a webinar together with Larry Bieferman. I hope that name sounds familiar to you. Bieferman and Bernstein wrote a paper called The Materiality of Human Capital on Corporate Financial Performance. Bernstein and Bieferman were both Harvard Business School. Well, Bieferman is Harvard Law School. I think Bernstein is business school. And they wrote a paper about 5 years ago The paper is actually a meta-analysis of academic research that has been conducted in the last 20 years on the materiality of human capital on corporate financial performance. So Bieferman, Bookspan, and I did a webinar on the materiality, and you can probably find that someplace. I think it's on YouTube. But let me just show you how Ernst & Young is thinking about it, right? This is the last page in their report. And basically, Ernst & Young is saying, you need to think about 3 big chunky areas. Human capital deployment, which is going to include workforce cost, attraction, recruitment, and turnover, workforce composition and diversity, training, learning, and development. That's one sort of category that could be material. Another category is employee health, so engagement and well-being, right? That will require that you actually create data, right? Because if you want to understand employee engagement or absenteeism or mental health, right? And percent of employees participating in health and well-being programs.
So let me just ask us a very operational question. If in fact you have declared that materiality includes understanding and improving engagement of my workforce, and that you're using X approach, I don't know, Gallup, whatever, to measure that, then you are, one, declaring it, but you're also reporting what the outcomes are.
Right. Well,
okay.
So here's where we have an opportunity to really make a difference. There's a difference between reporting data, right? And reporting how that performance in employee engagement or well-being or diversity, right, impacts financial outcomes.
Understood.
And I'm going to tell you something about some research that I'm doing also with the conference board, but with a different unit, about human capital analytics as a driver of enhanced performance. So
that is a critical issue for me, for you to be able to share.
So let me close this filing cabinet drawer, because let me tell you about the third category, which Ernst & Young calls organizational culture. Ethics and integrity, alignment with purpose, leading by example, performance and accountability, inclusion and well-being. So you can see that amongst this laundry list, we've got things that are very quantifiable, right? That are data driven, and we've got things that are policy driven. So if you as an organization says, which companies that are reporting around diversity, our goal is to have X level of diversity in our organization, then you got to report on that, right? If you declare a position, you have to actually report on that. If you declare that diversity is material and here's our goal, you need to report on that. And as Jerry was saying, you don't have to report if you don't think it's material. But if it turns out to be material and you have not reported, you expose yourself to risk. And what is a board all about? Managing risk exposure. So you want to make sure that before you go to the board with a recommendation, you've actually tested this out quantitatively to make sure that it is material to the organization. It has an impact on corporate financial performance, and you're doing that in conjunction with your advisors.
And I think the key issue for those of you who are leaders in talent acquisition or talent development, the real lesson here is that when you're building a business case to improve your budget or to sustain your budget, in order to invest in programs that you think are material, if you will, to the success of what you do and what your corporation does, you need increasingly, you're going to be aligned, if you will, to the work that your corporation has decided is material.
That's right.
And that gives you a context for building business cases in the future that will sustain your budget or improve your budgets to do the right thing for the corporation as well as the people. And I'm just fascinated by this pivot, if you will, in having a context, a better context to defend your budget or improve it based on what your company should be doing. And maybe obviously if they recognize you can help them put that together, it improves your position as well within the corporation.
So let me ask a question, and with a show of hands, just tell me whether or not your organization uses human capital data analytics to understand program performance, right? None of your organizations are using data analytics.
I would think that...
Yeah, we're of course using data analytics, but kind of the way you phrased the question, several of us just kind of leaned forward and went, what is she really saying?
So raise your hand if you have a data analytics person that is full-time in your organization working for either you or HR.
Both.
Now, that may not be the best solution for all of that, but at least you've got some kind of professional whose responsibility is HR data analytics kind of thing.
Mm-hmm. Yeah,
and that's quite a few.
I think the gap though is how is it being applied, right? Is it being aligned to those particular metrics, or
it will be down. It will be
exactly
downstream
to the ISO standard. Probably not, right? Some may be closer than others, but
and you ask a really, really good question, and that's the important question. However, we're doing research now with the conference board members. Many of you are members. Maybe even some of you even filled out our survey. We sent out a survey in February of 2020, right before COVID, which looked at the survey was asking you to respond to data analytics to inform the employee experience. Right? I don't know if any of you remember that survey. We did it in February. We did it again in October. So we're comparing pre-COVID and during COVID corporate response. And we're gonna release that report sometime maybe early second quarter of next year, because we're just doing the data analysis now and the writing. But let me tell you what I found. So it's really kind of interesting that we're looking at data analytics as the survey topic. And the way that the conference board does their own analysis of surveys is really by looking at prevalence. And what I decided is this is a data analytics survey, a data analytics report. We are actually going to apply data analytics to our data. So instead of just feeding back prevalence, we're actually doing diagnostic and predictive analytics on the data that we got from the surveys. We got about 100 and some odd, a little over 110 respondents, company respondents, of which 80 were public companies. And I'm interested in understanding company performance, financial performance. So what we did is we started looking at the data. And what I was also interested in is, does having a dedicated data analytics function in your organization matter? And what we learned is it does. So based on the survey responses that we got, plus curating financial information from public companies, so we used financial, statement data, here's what we learned. We learned that the HCROI, and we can calculate that because it's a standard calculation. It's embedded in the ISO 3414, but I'll tell you what it is right now so you're not in the dark. HCROI is calculated by taking your company revenue, subtracting from your company revenue, company operating expenses. But you need to adjust the operating expenses by your total human capital cost, right? So you're going to take all expenses and you're going to subtract out human capital related costs, the majority of which are going to be comp, benefits, and retirement. That's probably going to be between 80 and 90% of your total spend on people. So if you don't have the whole number, just subtract out comp and benefits and pension expense, and you're close enough. So you're going to adjust total expenses by human capital expenses, subtracting it out. And that's going to be your numerator. So your numerator is revenues minus operating expenses adjusted for human capital cost. And you're going to divide that by human capital cost. So what you're really seeing is a true return on human capital investment. Every dollar you spend, what's your HCROI? And that formula will help you calculate that. It's going to change from industry to industry because certain industries are very human capital intensive and others aren't. So for example, a REIT, a real estate investment trust, has a lot of revenues, a lot of assets, and 2 or 3 people, right? Whereas a financial services firm like JP Morgan Chase or Morgan Stanley is going to be very human capital intensive, where probably 70 or 80% of what their total expenses are is human capital related, right? So it varies by industry. What we found in our survey is organizations that don't have dedicated human capital analytics, right? They're not using data to inform their decisions, have an average HCROI of about 7.25. So for every dollar they invest in people, they get about a $7.25 return. Now, also, let me just give you a little, the conference board members are typically large companies. So our average market capitalization was about $100 billion. So these are large companies. Yeah. So just so you get a sense, we're not talking about mid-cap or small cap companies. We're talking about large companies. So they're on average, and again, this is all across all industries, their average HCROI was about $7.25. Companies in our survey that had a dedicated human capital analytics function, their average HCROI was about $19. I wrote over this number, about $19.75. It's about 270% more HCROI for organizations that had dedicated human capital analytics functions. Now, also think if we've got our average market capitalization is about $105 billion, $100 billion. These companies don't have dedicated human capital analytics functions. That's a little odd, but it's true. There are organizations that don't find any value in human capital analytics, and they're paying the price for that. So the first thing we saw was HCROI goes up. Why? Because whatever you measure improves, right? That's Michael Porter. If you're not measuring, how do you know how you're doing? So this makes sense. The other thing that we thought was really, really interesting is efficiency, right? So it's one thing to get a return on investment, but it's another thing to improve overall efficiency, right? How efficient is every dollar being spent? So we're actually prioritizing where we're investing, and we're getting efficiency out of that. Not necessarily return, but efficiency. And what we found was that organizations that had dedicated HCROI functions are about 14% more efficient than companies that don't. What does that mean? That means that the intensity of their investment in human capital does not have to be as high as organizations without human capital analytics functions to achieve the same outcome, the same productivity outcome, or the same profitability outcome. And we put this in a structural equation model. We did predictive analytics, and this is what we found. We found a very strong correlation between predictive predictive indicator that companies that have dedicated human capital analytics functions are more profitable and their employees more productive. So don't necessarily worry about the insights that you're getting. That's really important. Worry that you have a dedicated HC analytics function, and then use what you're finding in those analytics to inform the way that you make decisions around people programs and people investment. Brad, you had a question?
Yeah. Everybody that knows me, I'm jumping through a lot of things in my head. Going back years ago, Cisco, we were always doing E to B and employ. This is 15 years ago, and I'm still struggling to draw a correlation to that argument of having a dedicated analytics team, which organizations I have had that. And if I now apply the same principle at Intuitive, we're a very lean machine anyway, irrespective of the HR data side of things. So I'm still trying to grasp an organization that's naturally lean is going to have a higher ROI anyway, whether we do or don't have HCM analytics. I'm still struggling with it. I need to go and read this report to see what else is there.
Well, you're also here's one thing that is independent of this, and that is the attention that the CEO will give to human capital metrics has to go up in a public corporation in which he or she has to now report to financial investors some kind of set of measures that will probably evolve over the next X number of quarters. They will pay much more attention to it. So if you're making a claim that there are programs in which we could improve our focus on how we invest in our people, they're going to be paying much more attention to how that aligns to the measures that they're going to be reporting. And so what I see is much more alignment, if you will, and attention being paid at the C-level to what you want to do to improve the organization.
Right.
And I don't disagree. Whatever gets measured gets focused, absolutely. Yeah. But if you think about 5 or 6 years ago when the Googles, the Facebook started even talking about publicly their diversity data, has anything changed in that? Probably not. We talk about it, but we already know it hasn't really moved the needle. So I get it may get attention, but until something happens on the other end that's going to force the hand. I can fast forward and say, wow, you look at the profitability of a company and invest based on this. That's a pretty interesting metric when you start thinking about investing in companies.
Yeah, and if you think about what the HCMC was saying, and again, I am happy to share that 24-page paper that they sent to the SEC, because that was sort of like the foundation. And then the SEC actually opened it up for comment, and that comment website stayed open for about a year. And you should see the comments that actually drove the SEC to saying, yeah, we probably should ask companies to disclose on human capital, but we are not going to be the ones to tell you what to disclose. What they basically did is they defaulted to the investor community. The investor community is going to now say, we want to see HCROI, we want to see attrition, we want to see diversity, we want to see equity performance. The investor community is going to be the 600-pound gorilla in the room, not the SEC.
Yeah, they're going to consume this information and make their own judgments. And that feedback of the judgments they make is going to inform you how you're going to operate from that point of view. I do want to point out that when I first saw Dr. Charas, she was giving a case study in which she was examining over the course of several quarters the HC ROI of a given company. Again, it's an anecdotal thing rather than a large statistical thing of a lot of companies. But in this particular case study, she was showing or demonstrating that a company that was reducing its investment in people was still showing some interesting, good financial growth, but not anywhere near the growth that the industry was getting. And so they were improving their performance, but not at the rate of their competitors who were making higher investments in the people within the organization. And if I were an investor, man, having data like that would certainly help inform me which stock I'd be placing my bets on. So I think that has interesting impacts.
I'd love to see that report if we're able to share that. That'd be.
I mean, I can share the graphic that I think Jerry is referring to. What can we anticipate with the Biden-Harris administration, right? And I think that everybody is asking about that. So the first thing is, we know that the SEC was influenced by the ISO, influenced by the HCMC, and they basically said, we're not going to do something prescriptive because that doesn't work. We've seen that doesn't work. We're going to let the investor community determine, based on how they view investments, what they're going to ask companies to disclose. And it's going to be companies like CalSTRS and CalPERS and OPERS and, Walden Financial Management, State Street and BlackRock. They've all already come out and said, we want to see ESG information. But the idea is we as HC people have to become very financially literate. We can't just say, oh, we've got good culture and we've got good engagement. That's not going to cut it. What's going to cut it is HCROI is improving. HCVA is improving. Our human capital market value is improving. You have to actually speak a financial language so that the CEO and the CFO will understand what you're talking about, because they don't understand culture and they don't understand engagement.
I think there's going to be some interesting sets of issues. I do want to be respectful of the time because we did plan for about an hour.
Right.
I do want to do one thing. Well, Dr. Charas, just explain that particular.
Yeah, and I'm happy to stay on for a little bit longer. I've got another call coming up, but I can stay just a few more minutes. But this is a client that is in our human capital, our HC Moneyball platform called HC Metrics. And these are the kinds of things that we allow users, subscribers to create for themselves. The blue bar, because the legend is too small, the blue bar is the client's EBITDA performance month by month. The orange bar is the EBITDA performance of a filtered set of competitors that subscriber wants to look at. So we've got all public company, and they filter it based on SIC code, based within the SIC code, based on size, revenue size, EBITDA size. So they get to pick the competitor group against which they benchmark themselves. And you can see that their EBITDA is going up month by month. Any CFO, if they're just looking at the blue lines, would say, yay, we're good, we're doing well. But if you compare it to the orange bars, you can see that they're dropping behind their competitor groups pretty quickly by the end of the year. They're lagging. And the two lines, the purple line is the competitor group, HCROI, and the gray line is the subscribers' HCROI. So their HCROI went from $4.60 down to about $4.10, which doesn't sound like it's a big problem, but you can see that poor HCROI performance is dragging down their EBITDA performance. And we know that they're related because we use the same numbers to calculate, right? So this is a visual representation that will be very useful in the boardroom, right? And that's what we're saying, is that we've got to change the way we communicate and interpret what we're doing.
I really appreciate the time that you spent with us, Dr. Charas. I think it's fascinating.
7 people in this room, so
I know we're kind of ending it, but I think what we're committed to doing is helping to educate our members on some of the opportunities, and our alumni and friends on some of the opportunities that are out there and where they're going. So appreciate all your time and effort in relation to this. Look forward to chatting with you in the future.
Thank you very much.
Thank you very much.
I enjoyed speaking to all of you. Thank you. And thank you for participating. Your questions were great.
Thanks for listening to the CXR channel. Please subscribe to CXR on your favorite podcast resource and leave us a review while you're at it. Learn more about CXR at our website, cxr.works, facebook.com and twitter.com/careercrossroads, and on Instagram at careerxroads. We'll catch you next time.